Indonesia has captured 60% of the global nickel supply, but the real owner is not who you think. For the Singaporean investor, this monopoly walks straight into your kitchen rice and your retirement math. Today, we perform a forensic audit on Indonesia's nickel nationalism and the margin squeeze hitting your portfolio. Every great port city in history has faced the same existential question. What happens when the trade route moves? Our ancestors in Malacca asked it when the winds of commerce shifted, and Rotterdam asked it when containerization rewrote global logistics overnight. Now Singapore is asking it as the economic center of gravity for critical materials shifts south across the Java Sea. This is not just about a raw material. It is about a regional monopoly that rewrites the cost of living for every household in the heartlands. We are watching the construction of a geographic moat. The global headline is that Indonesia has fundamentally rewritten the corridor economics of base metals. Through a series of legislative export bans, Jakarta has forced a staggering concentration of supply. Indonesia's global nickel production share surged from 31.5% in 2020 to approximately 60% today. By 2030, that is projected to hit 70%. The export value exploded from 17 trillion to 510 trillion rupiah by 2024. This is no longer a free trade corridor, it is a fortress built on laterite and legislation. For a Singaporean investor managing CPF or SRS portfolios, this regional monopolization translates directly into margin risk. Jakarta is currently running what I call the wet market lobang paradox. They act like a market owner who bans all outside suppliers to force everyone to buy from their own stalls. The consensus narrative calls this a triumph of an emerging market. But the raw data reveals a different capital flow. When one neighbor controls the material and another controls the capital, the local equities caught in the middle face an unprecedented squeeze. Who really controls the tap? Beneficial ownership tracing confirms that Chinese firms now control at least 75% of Indonesia's nickel refining capacity. Local Indonesian firms are trapped in low-value activities, holding a mere 13% of domestic capacity. This is not domestic sovereignty. It is a monopsony where Chinese Indonesia smelting consortia dictate domestic ore prices, keeping them artificially below world benchmarks to starve local miners while subsidizing their own downstream margins. This is the forensic reality behind the headlines. Here is the Iggy's insight you need to hear. You are not watching the rise of an independent ASEAN manufacturing powerhouse. You are watching a $65 billion monopsony built on captive coal. The true sovereign risk is not that Jakarta controls the battery supply chain, but that Beijing controls Jakarta's output. The psychological gap between what institutional money celebrates and what the forensic data shows is vast. This is about proxy control, and the balance sheet archaeology tells a story of dependency, not independence. This corridor shift does not stay in Morowali. It walks straight into your daily expenses. The most immediate transmission is hawker inflation, which reached 6.1% recently, with staple noodles and rice up 8%. We blame labor and rent, but the hidden tax is the metal. Nickel drives the cost of Type 304 stainless steel, used in 90% of Singapore commercial kitchens. Every time a stall is refitted, that cost is eventually passed to you. The impact moves from the smelter to your chicken rice. A standard Toa Payoh hawker stall faces a 12 to 15% material cost increase compared to 2020, driven entirely by export ban volatility. The hawker does not absorb this, you pay for it in your lunch. Furthermore, rising nickel processing costs inflate the green inflation we see in electric vehicle charging infrastructure across HDB car parks. The materials for our green future are getting structurally more expensive. This shifts the fundamental retirement calculus. The 4% yield from your CPF special account is no longer just the default. It is a critical sanctuary. To justify pulling money from that sanctuary for SGX Industrials, you now require a minimum equity risk premium yield of 4.7%. If you are drawing down SRS funds, you face a heightened sequence risk. Distribution cuts hit precisely when your daily costs for transport and utilities are structurally elevated. We see the squeeze on both sides of the ledger. Industrial REITs are facing rising utility costs tied to captive coal for processing, which is 2 to 6 times more carbon intensive than traditional methods. Meanwhile, technology manufacturing firms watch raw material costs for specialized components compress their operating margins. On the surface, it looks like regional progress, but for the heartland investor, it is a margin squeeze that threatens the sustainability of your dividends. Before we go deeper, if this forensic breakdown is useful to you, the single most useful thing you can do for the channel is hit subscribe. It takes 2 seconds and it tells the algorithm that data-driven SGX analysis deserves to exist. Retail investors are completely failing to price in the shadow cost of captive coal. Indonesia's captive coal capacity exceeded 15.5 gigawatts in 2024, with more on the way. As Singapore tightens mandatory ESG reporting, that embedded carbon becomes a direct financial liability for every firm in your portfolio. Your supposedly green investments will eventually bear the margin-crushing cost of offsetting the very supply chain they depend on. That is the forensic punchline. Looking at the macro dashboard, we see that price stabilization in nickel masks a structural concentration. The most critical signal is the RKAB production quota. It has been throttled from 379 million down to 250 million tons. This artificial supply constriction is designed to enforce price floors. While the Singapore Import Price Index has dipped slightly from its highs, a base material cost floor has been established that is much higher than the historical average. The 34% reduction in the production quota is our forensic linchpin. Indonesia has intentionally throttled output to prevent prices from returning to a free market equilibrium. For a 55-year-old investor in Marine Parade relying on dividend holdings, these elevated manufacturing costs are now permanent structural features. You cannot wait for a return to 2019 prices. The regime has changed and your portfolio must adapt to this new supply-side dominance. Turning to the SGX sector watch, the landscape is bifurcating. Mapletree Industrial Trust, or ME8U, is pressured with a gearing of 37.2% and falling distributions. Venture Corporation, ticker V03, is on watch as nickel-intensive component costs eat into their 9% net margin. Keppel BN4 remains supported due to its asset-light pivot providing a buffer. However, companies like Franken and Ascendas REIT remain sensitive to these base metal floors and rising utility costs. We have three possible scenarios ahead. In the bull case, a US-Indonesia trade agreement lifts bans and recovers industrials. The base case, which carries a 50% probability, sees the 250 million ton discipline holding, with nickel staying between $17,000 and $20,000. In the bear case, Chinese smelter defaults could trigger an inventory dump and a price crash, leading to systemic dividend cuts across the SGX. You must be prepared for the base case as the most likely path. Ask yourself these three forensic stress test questions. First, if your REIT gearing exceeds 35%, how many quarters of tenant defaults can it absorb before cutting your paycheck? Second, does your blue chip industrial have the pricing power to pass on a 20% alloy cost spike, or is it a yield trap? Third, does your equity yield genuinely compensate for this volatility, or is the CPF sanctuary the smarter move for your SRS deployment? My personal sanctuary threshold remains 3.2%. A sustained macro shock does not change the floor. It changes how many assets can still clear it. When the winds of the trade corridor shift, the fundamental question isn't how much you can make, but how much you can keep. We need to look at the shock absorption of every name we hold to see if they can survive a permanent shift in material costs. Our shock absorption audit shows Venture Corporation has less than 1.5% margin headroom before earnings are compromised. Mapletree Industrial Trust can handle about a 10% drop in net property income before a cut. But that buffer fails if interest rates escalate. Keppel's asset-light pivot provides a massive buffer, while Franken faces a collapse if the manufacturing index dips. You need to know exactly where the breaking point lies for your specific holdings. If you are still accumulating, watch out for value traps. Venture Corporation only enters the forensic watch range if its $1.28 billion in net cash is deployed to diversify away from nickel-dependent chains. Without that pivot, high yields in materials are simply the market pricing in an inevitable distribution cut. You cannot afford to buy into a dividend yield that will not exist by the time you stop working. If you are already drawing down, you must have zero tolerance for margin compression. Monitor Mapletree Industrial Trust closely. Can it maintain a 6.4% yield if occupancy falls below 90%? When your distributions cover utility bills and daily expenses, cash flow is non-negotiable. You cannot wait for macro normalization. You must demand assets that possess the fundamental strength to pay you even when the corridor is choked. The retirement question is simple but heavy. If your industrial dividend income dropped 15% tomorrow because a Chinese smelter in Morowali defaulted, would your remaining CPF life and SA interest still cover your transport and utility bills? Or are you betting your retirement on a mineral monopoly you do not control? This is why we look at the data to ensure the sanctuary is actually secure. The baseline cost of our industrial economy is now being dictated by a handful of Chinese-backed smelters in the Sulawesi jungle. When the trade corridor becomes a choke point, the capital sanctuary you thought you held in local industrial equities is revealed. It becomes nothing more than a toll booth collecting a steadily diminishing fare. The sovereignty of our supply chain has been quietly outsourced to a monopsony that does not care about our heartland needs. Consider the technician in Woodlands who has spent 2 decades accumulating tech manufacturers and industrial REITs. He assumes geographical boundaries insulate him, but his dividend stream is tethered to a coal-fired facility 1,000 miles away. He sees a high yield and thinks opportunity, missing the structural debt wall and the margin compression that follows. He is managing a portfolio built for a world that no longer exists. You are not here for the copy tips or the hype. You are here because you want the forensic truth before you commit a single dollar of your capital. That tells me you are the kind of investor who values evidence over emotion. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. This is a red zone environment for many industrial counters. If you want the 0-day forensic sheets for these names, Iggy's elite investors get them before the market opens. There is a 7-day embargo on this data for the public, but you can get the full audit today, link in the description. The regional shift in nickel is a permanent structural change to the Singaporean investor's margin of safety. Whether it is the cost of your chicken rice or the sustainability of your REIT dividends, the Indonesia factor is now a primary risk. We cannot control the geopolitics in Sulawesi, but we can control our allocation. The choice is between betting on a monopoly or building a portfolio that can withstand one. The algorithm does not know you check the gearing ratio twice. It only sees one signal, whether you have hit subscribe. If this analysis helped you identify a risk or calculate a margin of safety, subscribe for free and share this with one person who needs to hear it. Let's tell the algorithm that data-driven SGX analysis deserves a seat at the table. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.